is going on, beautiful people? How you doing, Crypto Craig? What's up, buddy? Sadie sometimes, Dom G, Mark Marie. What's up, buddy? Geek of all trades, Crypto. I already said Crypto Craig. Let's see. Automatic Beats. What's up, buddy? Kyle, Rosa, Old Man Crypto. Good to see you, Carl Coat, and Jeremy. Travelers Travels. What's up, buddy? Good to see you too. John Carpenter, my man. All right, let's see. So they have a live thing going on right now over at Bloomberg Television. So we'll watch that. But right now, I just want to look at the market quick. 28,657. Ethereum is at 1886. So not too bad. Anybody that was in this SUI coin, I apologize because that's absolutely freaking miserable. Down 70.4%. I don't know if it's a new coin. I have absolutely no idea what it is. Yeah, definitely new. Just came out and just took a shit. All right, another rug pull. Nice. Bitcoin's I mean, I guess we'll see. We'll see what happens, right? Anyways, all right, let's get on to, where is it? This is the live BS going on right now. So we'll listen to this and chat while we're listening to it, I guess. That's probably the best way to do it. See what they got to say. I think he's going to be going live, in like 15 minutes, I think, if I'm not mistaken. So if you guys have questions, please ask.
They have to get all the way to
Feel
2
free.
before you see those adjustments.
If
right,
we
let's
look at
see.
where we are with our start and the
What's up, Andrew? Good to
calculations
see you,
that
buddy.
people like you make up to see what the path is forward, there are other ways within the system to be more restrictive. And of course, one of them is banking trauma. Are we more super restrictive now or more tight than the chairman realizes?
Well, I'm not sure what the chairman realizes, but I do think, and I certainly believe.
So I'm going to turn this down a little bit. Just so you guys know, this is probably going to be a bit boring, right? But I want to see if Jerome Powell comes out and talks a little bit, because it'll be interesting to listen to anyways, to see what's going on. Oh yeah, dog, that's tight. What's tight? What are you saying? What's tight? This right here? This whole Fed raise. So I mean, we were expecting 25 basis points, right? Overall, the crypto market shouldn't react too hard. If it went up higher than that, it probably would have went nuts. If it went lower, it probably would have I don't know, probably would have came back a little bit, but who knows?
Fomc and Matt Luzetti earlier, who said that they think that the bar is higher to cut rates.
Oh, the old man with the glasses said it was tight. Oh, I got you.
Well, let me think through
Retro
that.
Mike.
I think
Such a troll.
Inflation's just too damn
damn
high. It's not.
I'll let it read it for you. We'll give it a minute. There you go. There it is. Over my face. The wife said I needed to move it, actually. Where should I move it to? Put it in the middle? Right here?
Boring is your style.
It's fucked up, Retro Mike. Messed up.
Right now, as we
Oh, you
look
suck.
at this statement and we understand.
All right,
what
so
you're
again,
saying,
about 15 minutes
what
or
more
so.
do they have to see in the banking sector in order to say, okay, hold
Good
up, this is
afternoon,
something
high-low
really
crypto.
serious
Good to
that
see you,
needs a little
buddy.
bit more
So we're just sitting here talking about the, watching the Fed rate hike, 25% or 0.25%, which is, whatever. Not too crazy. Not too crazy right now. But overall, everything's looking fairly decent. Let me see if I can. Just going to listen to this in the background. Check out the markets and shit while we hang out for a bit. Actually, I want to see what... Oh, geez. Look, Pepe just took a shit, too. That just happened. That wasn't there 10 seconds ago.
And we may not have seen the last of that.
There goes my Tesla payment, said Dan R. Oh, man. Crazy. Well, I guess we're going to see what happens with Bitcoin soon. Let me look at the last hour, just for shits. Doesn't look, I mean, it's been steadily going up, just chilling. It's kind of flat, like everything's really just flat. So I guess we're going to have to wait and see. Is anybody into this Pepe stuff? Anybody? I want to see what this SUI is. I'm going to see if I can find anything on this in a second. Let me make this bigger.
110.65. The news conference, you're laughing, aren't you? 110 euro dollar. You love that.
Yeah, it's great.
11 minutes away from that news conference. It doesn't seem to change, Rich. I keep saying the same thing. Rich, I just want to jump in on the banking stress. Your former colleague John Williams of the New York Fed, has really played down the role the Fed has played in this by hiking interest rates from 0 to 5 so quickly in a little more than a year. I'm just wondering what your assessment of that is, the contribution of Fed policy over the last 12 months to what we've seen play out at the regional banking level.
Good question. I have enormous regard and worked closely with John
This is that coin.
for nearly 4 years.
This is
I
what
think
we
as
were
a
just
Fed
looking
official,
at.
He is careful in how he chooses his word. I'll just tell you what.
SUI.
What I think in every rate
37%.
hike
That's on the
cycle,
whole day. Oh, look at this.
banks
So it
that
just
have
came out today.
exposure to
It's new.
interest-sensitive assets are going to
Yeah,
face
9 this morning.
challenges. You know, in the case of First Republic, they
No.
hold a lot of mortgages.
Yeah.
Mortgages get hurt when the rates go up. In
Yep,
the case
yep.
of SVB,
Brand
they
new.
held a
Started up
lot of,
high,
you
took
know,
a dump.
securities, and so I
Not
think
surprising.
banks do maturity transformation. They borrow short and lend long, and when bond yields go up a lot, some banks are going to be.
All right, let's see.
are
What are
going
you
to
guys
be
saying in the
challenged.
chat?
And so I
What
just
does everybody
it's an
think about this?
inevitable
Obvious
part
Miner, what's up,
of,
buddy?
Of monetary policy. As I said, the banking
Another
system as a whole
meme coin?
is sound, but banks that have big exposure.
I don't even know
to
what
rising
Pepe
rates
is,
that they
honestly.
didn't
Oh,
hedge
yeah. Yeah, it's
are
another
not
meme coin.
surprisingly
Yep.
going to get hurt.
And I can ask you this
It
because you're
is.
the
Oh,
monetary guy. If
we
you're the
can do that.
regulation guy, I couldn't ask you this, Dr.
Let's see.
Clarida.
So-
but, you know, for you it works, and with your
I just want to
experience
see
in
what
public
Jerome Powell says.
services
So I think we have
and
like 9 minutes or
it's
something. I
real
think
simple.
2:30.
Everybody's
Is that when they're
scared
supposed to be
stiff.
having like the
Back to
press
where it
conference, or is that not
is.
happening? Hopefully that happens on
Back
this
to
channel.
where
I don't
it
even
is.
know.
Kathy Jones over
What the
here
hell? Where'd it go?
just out
Where'd the
with
Pepe
a
thing go?
TR, rating.
Am I on
Back to
drugs?
where it
Did we not all
was.
just see that?
2006,
Bosscoin talked about Pepe. All right, there it
2006.
goes.
Michael
We're all
Spence
talking about
was
it.
eloquent in 2010.
Old man crypto, you dirty old man, you.
07, 08, 09. Are we
All
there
right,
yet?
let's see. So, damn it, how did I just click on that by
I
accident?
don't believe we're there.
Let's go back to
what I will
CoinGecko
say, is, that,
and look at Pepe.
and I think the report that we got out of the Fed and the
So
and the
stupid.
GAO, I certainly read
So
both of
stupid.
them, carefully, and clearly there were things that were
6
missed, not
zeros
so
and
much
a
in
9, so it
regulations,
dropped
but
or
perhaps,
added a 0.
in
Interesting.
supervision, and I do
What's
think
the? Let's go to the
that,
max,
we will
right?
see that,
When did this come
change,
out? April. So this
pretty
came out
quickly, and
the
certainly I
18th of
think that
April,
would be a
17th of
good
April.
idea.
Rich, you know the Federal Reserve.
Well, at least it
is
didn't
also
come
one
out
that
like
has been
super
heavily
high and
criticised
dump,
over
right?
The last few months regarding this issue. Can you share
Interesting.
some of your experience in your time?
I mean, but yeah, it
Do
had
these
some
issues
sort of a
ever come up
freaking rally,
at
man.
board
It's
meetings that
insane.
you attend
The
to
amount of money that
around the
people must have
names
made
that
off this.
failed
I mean,
over
it's
the last
just
few
nuts,
months?
man.
Were these
I don't
factored in
know.
any way, shape,
What do you
or
guys
form
think? Is it
at
worth
board
just
level?
getting in like $100 on a shit coin like that and just see what happens?
Let me just say.
What do you guys
this.
think?
I was surprised.
Let me know in the chat. It's probably you're probably risking to lose it, but well, you're definitely risking to lose it. But overall, is it worth? You think just throwing $100 in this thing? I don't even know where you can get it, to be honest. But let's see actually. Oh, MEXC has it. Uniswap, Gate.io, and OKX. Nice. Let's see. No gas fees. Why I hate it, dude. ETH is awful with gas fees. Absolutely terrible. And I apologize to anybody that can hear the talking in the background. We're listening to this. If anybody's just joining, this is the breaking news of the Fed rate hike. So I want to see what the actual I don't know, press conference, I guess you'd call it, says, right? Jerome Powell should be coming on, hopefully.
I think I'll just leave my answer at that. Obviously,
So we'll
I've
see.
not been in the building, for
Let's see. Someone
15
lost
months,
250K
and
cashing
I'll
out
just leave my
Pepe.
answer at
Wait,
that.
what?
All right. Well, just
I think I heard that actually. How did that happen? How is that possible? How do you lose that much money?
This is important is because people often think
Trying
of
to
these
cash out.
independent items, right? You've got on one hand policy, and you definitely have an
That's
inflation
crazy.
problem. But John, you have to wonder if at a certain point you're kind of challenged if you have
$25 and $25 in gas fees. Jesus.
Rich, I don't think
Yeah,
we're
but
gonna let
like,
this go.
isn't it supposed to be?
You
So
were there.
the article we read this
guys
morning,
knew
right?
behind-
I'm just gonna turn this shit down. I'm gonna put some music on until we oh, didn't mean to do that. Sorry guys, hold on. God damn it. Nope. Didn't do that either. There we go. Sorry fellas. All right. Let me get some music on. I need to go into my Windows tab. Underprepared today. Let's see. There we go. Listen to some music while we hang out, wait for this ish to happen. Let me see. What are you guys saying there? Dumpster fire. You like that meow coin, right? That's I did that for Hawk Crypto. I don't even know what the hell I was gonna say. I was gonna do something right now. Oh, the article from this morning. That's what it was. Man, I didn't have coffee today. I can't believe how dependent my body is on coffee. It's awful. It is so awful. So I'm gonna have to either get coffee or just take a week off and see what happens. All right, let's where is it? Where is that article from this morning? It said something about what was it? BSD or something? Oh, BRC, here it is. BRC, Bitcoin BRC20 token standard becomes a new destination for meme tokens. Isn't this supposed to be like lower? Or am I wrong? We read this morning a bit. It says Bitcoin's BRC token standard has become the latest trend in the crypto ecosystem, especially after the Pepe meme coin rise in recent months. A total of 8,500 different tokens have been minted using BRC20 standard, with the majority of these BRC20 tokens being meme coins such as Pepe and Meme Tick. Is that how you say that? Meme? Weird. BRC20 is an experimental token standard on the Bitcoin blockchain modeled on Ethereum's ERC20. It allows programmers to create and send fungible tokens via the Ordinals protocol. Although modeled after the ERC20, the BRC20 token standard fundamentally differs from the Ethereum-based counterpart. BRC20 tokens don't make use of smart contracts. The token standard also requires a Bitcoin wallet to mint and trade these tokens. The BRC20 token standard was created early March by an anonymous on-chain analyst called Domo. The objective was to make it possible for fungible tokens to be issued and transferred on the blockchain. The market cap of BRC20 tokens has exploded over the past month and currently sits at 120 million, a 600% rise in the past week. So yeah, there's like a list of tokens here that you guys can see, right? Pepe is number 2 there. I thought it was supposed to be cheaper though. Am I wrong? Gas fees? I thought they were supposed to be cheaper. Where the hell does it say it? Interesting. Sorry, not looking at the chat. What are you guys saying? I'll drink my coffee for you. Appreciate you, Andrew. This is the Pepe. That's one of the Pepe memes, and I've been using that one forever. Not on the channel, but in general in Discord. And yeah, apparently it blew up with all different kinds of, I don't know, its own crypto and shit. I mean, it has been kind of the meme standard around this, you know, this thing. Around crypto, rather. What am I doing? Here we go. All right, so I guess we're just going to sit and talk, listen to some music while these guys talk, and I want to see what happens when it comes to 3 minutes from now. 3 minutes, we should have the guy talking, right? Jerome Powell? You should get royalties. No. Yeah, right? No, it's, I don't even know who created all those memes, honestly. The Pepe, like, the guy that created it, I don't know if he created all of them or if people just kept drawing them. Does that make sense? Pepe's greater than HNT. I agree there. 100%. FHNT, man. Oh, by the way, actually, I need to get my HNT miner. You know what? I might do that today. I might try to do that today. I'm going to reflash it with the crank stuff that Network Bits talks about. Let's see. Oh, my Discord's not open. Let me see. Let's get Discord open. And I want to grab, of course, it would be installing an update right now. Oh, at least it was fast. All right, good. That'd have been terrible. Let's see. Chair Powell to speak any moment, it says. So as soon as that starts speaking, we'll jump over there and listen to that. All right, let me find Mr. Network Bits DM with me. I gotta get it situated. He's gonna actually need to call him and get this thing completely set up. But this is the crank stuff, right? So he actually, what's it called? Said this. I mean, he thinks this is a good idea. It's gonna be a good project eventually, and you can convert your helium miners, or at least the my MNTD, the rack wireless ones. And then there was another one, I forget. Let me see what his thing says. It is rack and sense cap. So I'm going to put this is his video, Mr. Joe, over at Network Bits. If I could blow that up, I'm gonna share this. If you guys would go like and subscribe to Mr. Network Bits Crypto, I gotta watch that later. But Yeah, he sent me that information. All right, let's listen to this and see what's up.
Change it last time around.
You're more detail focused, Tom. Maybe it has
Yes.
changed. but I
Jerome
can't notice
Powell's
the
going to be
difference.
speaking.
We're waiting for Chairman
any
Powell to
moment.
walk into that room. A 25 basis point interest rate hike. Going into it, your equity market is positive by 0.4% on the S&P 500. The bond market.
I just threw Joe's video in the chat. If you guys would, if you're not subscribed, please go subscribe. Mr. Hobbyist Miner, what are you saying? I have a video dropping tomorrow of using my gold spot MNT miner and installing Crank. You would. You would.
Usually he's pretty prompt. Have you noticed
You
that?
would.
This is actually
That's all right. I'm doing the black one anyways. I gotta do both actually. I gotta do the black and gold. Here he is. Here's the man. All right, let's see what he says.
After hiking interest rates by 25 basis points, let's listen in.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.25 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is, so let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel. Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Mr. Chairman. Thank you. Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank which talked about, the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful, but ultimately it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities, and at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Thank you.
Go to Victoria.
Hi, Chair Powell. I wanted to ask you, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Let's go to Colby.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to. Before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, if I could. Could you give us a sense of what the SLOOS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLOOS on May 8th, in line with our usual time frame. And I would just say that the SLOOS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Let's go to Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last 2 meetings, been seeing the effects of those moves. Why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time, and that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen, take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that, that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
But would you be okay with a prolonged 3%?
Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process. I think we're going to need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt. Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as you know, we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. You know, it wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems that to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet, wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So, I think it's still possible. I think. The case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have expanded, did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it will, of course, it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. It's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down. Not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, then markets have been from time to time pricing in quite rapid reductions in inflation. We'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down, particularly now if you look at non-housing services. It really hasn't moved much, and it's quite stable. And so we think demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney?
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now, what happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan Banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on over the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Okay, Sarah.
Sarah Ewell-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can do. Can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the regulatory or the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way. A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that may just have been technology evolving. You know, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them, and that's kind of the only thing I care about is. And I feel like I am accountable for doing everything I can to make sure that happens.
Go to Evan.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress. Okay. I also think we are very focused on what's happening with credit availability, particularly with what you saw in the Beige Book, and you will see in the SLOOS is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Okay, Greg.
Thank you, Fed Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations, and I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for Supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for Supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately, and I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires, and but it isn't. I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and having an intelligent discussion about what's going on and why, and that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Great. Thank you.
Is that it?
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board.
Keep calm and buy Bitcoin.
I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there. But that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious, too, how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. I'm it will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing.
Not financial advice.
I guess I would just say that. Then we're going to revisit. It's pretty clear we need, to me anyway, it's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
That does it for the main news conference of the Federal Reserve.
All right, done and done. Hopefully you guys enjoyed listening to that snooze fest, but it's whatever, is what it is. I just wanted to play it live for anybody that might wanted to have seen it. Guys, go check out Bloomberg Television. I'll leave a link down below if you guys are interested in watching it full screen instead of with me on the side laughing to your stupid jokes in the chat. Also, real quick, I want to replay that super chat thing. I want to see how it works. I mean, the new member rather. I put Bowser on there. It says open the gates. Let's see how it sounds. I gotta mute this actually. There we go. Let's see. You guys couldn't hear it. There it is.
Open the gates.
That's sick. Came out good. All right, I gotta turn it up a little bit because it's actually quite quiet. All right. So, anyways, what do you guys want to talk about? CKB. We're gonna be getting out of here shortly, but CKB. Somebody said it was dumping. Am I wrong? Let me see. Let's go check CKB. Price wise. All right, let's see. Appreciate you guys for the donations and the membership. You didn't have to do that. What am I doing? CKB. Nervos Network. Let's see. I got to change this thing on the bottom too. There we go. Get away from that. Down 6.2%. Oh, geez. Has been going down, huh? Interesting. What's the profitability on the ASIC? Let's see. Was it the K7? Yeah, K7. This is at 10 cents. If we go to like 7, we'll do 17. Say the K7, $1.15 a day. I mean, still profitable, but yeah, that sucks. That's tough. That is tough. Every dump, I am buying more. There you go. CKB first dumped, now pumping back. Gotcha. All right, so you're just buying back in. You know what? These hooks like this actually play out usually pretty good. As you can see right here, one kind of jumped. It jumped a little bit and then, rose up. That's usually how it goes with those kind of like jackknives or whatever they're called, fish hooks, whatever the hell they call them in friggin' trading. I canceled 2 Hive mappers. Oh, really? Interesting. How come? Why is that? My Hive mapper order number 1700. Wait. Yeah, but that doesn't mean 1700 people, does it? That's crazy. Sustainable crypto. I wonder why you canceled them though. Interesting. I want to know if I'm going to get paid out actually. Let me look. My app. So you get paid out on Thursdays, I think, right? And my Hive mapper, I used it. Yeah, it still says pending coverage, but it says reward period 4/24/23 to 4/30/23. Pretty sure something's wrong, if I'm not mistaken. Sorry guys, light is wicked bright. See that? Pending. A dirty ass phone. Weird though, right? I don't know. I guess we'll have to see. All right, Asia is sleeping. Watch the Chinese coins in 6 hours. Ooh, that's a good guy. That's a good call, actually. Black sales. You imagine? Interesting. You get nothing. Yeah, pretty much. If I get nothing, I'm gonna be pissed. I'm gonna say something. I'll mention it to them and just find out. Like, hey, listen, did I do something wrong in the setup? Because it was super simple. Connected the wallet, and that was it. Interesting. Overall, Bitcoin isn't really moving much. Not pumping, not dumping, just kind of staying steady. 1.5% down, but that's normal. You know what I mean? Up and down a little bit. So you get paid the following Thursday, probably after the reward period. If I had to guess, yes. So I mapped the Saturday before this past Saturday, right? So it was literally over a week ago at this point. So I should have gotten paid out that day on Thursday, but it depends when the uploads happened, I guess, if I didn't have cellular uploading on. So I gotta see. I don't know. I'm hoping Thursday it comes through. Chump, my nickname should be Mini, Minor, Nerd, or Dumby. Dumby? Is that what you said? Let's see. Yes, no, guess I tagged you. Let me see. What? What are you saying, Hawk? It's a week late. No, it's a week late. Okay. No, I know it's a week late. So like it goes from Sunday to Sunday, right? Or Monday to Sunday, or however they do it. I don't know. The payments start. No, it's Sunday. It would be. How does that work? They pay out on Thursdays. That's so strange. But it would still go Sunday to Sunday, right? Or Sunday to Monday, or Monday to Sunday, rather. I guess. You always get ignored. That's why. A week behind in payments. No, I know. I heard you. I said that. No, I know. I'm hoping that. It's weird though, Hawk, because it's been 2 weeks. Like I feel like I should have gotten paid last Thursday, but because I didn't, I wonder if this following Thursday is only going to be the 2 weeks ago that I mined. You know what I'm saying? I don't know. We'll see. We'll see. Everyone chill the F out. Says Hawk. Hawk's upset. Listen, they're not going to take away your commissions. Don't worry about it. Take it easy. Take it easy. Oh, I don't even know. Your coins are still gonna be there. They're I don't know, it says pending. I just gotta figure out what the hell's going on with it. Let's see. No gifts for a bit. I am way over budget on it at the moment. All the misfits covered. Dude, Joker Miner, don't gift anything. You don't ever have to gift any money, donate anything, gift memberships, nothing. You don't have to do none of that, man. Appreciate you though. You're awesome. All right, so this new coin came out. I don't know what this is. It's not mineable, I don't think. Sui, whatever the hell that is. SUI looks like a pull, if I'm not mistaken. We already looked at it this morning, or this beginning of the stream rather. Down 39%. It just came out today, and yeah, right down to the floor. Dropped $1. So I don't know if anybody's interested in that. Feel free to go check it out. But overall, guys, that's really it. That's it. Where's the rich folks at? I don't know. Who's rich? Not me. Without even seeing who made that comment, I knew it was Joker Miner. Yes, 100%. And if your wife wants the money back, just let me know. I can give you whatever YouTube gives me. No problem. Joker Miner's eating ramen because he gave all his money to Chump Change and YouTube. LOL. Dude, yeah, mostly YouTube because he tipped everybody. He gave 20 memberships to all of us. Me, Max, Hawk, and King. And I don't know if he did Geek of All Trades. No, Geek of All Trades doesn't have memberships, so just us four. But yeah, it's crazy. Absolutely crazy. And Panda's gone. Yeah, the rich folks are gone. Panda was the only one. All right, fellas, I'm getting out of here. That was a snooze fest of a stream. I apologize, but hopefully you guys enjoyed it. If you did, hit that like button. If you didn't, oh well, no big deal. I'll see you guys bright and early tomorrow morning, 8 a.m. Eastern Standard Time. And we should be, I think I have about 200 members at this point. I think. Almost. We're getting there. We're like this close. There's a super chat, so I'm just going to wait for it to go off. I feel like all cryptos should go away except POW. And... kinda, maybe. I don't know. We'll let it read it.
I feel like
There it
all
is.
cryptos should go away except POW.
Well, again, yeah, it's I mean, I don't know. We can debate on that tomorrow if you guys would like. All right, have a good one. I'll see you guys soon. Peace out. Panda, enjoy painting your floor or whatever you're doing today. See ya.